Everyone thinks Dubai has taken over as the new king of business hubs. But here's the catch. Even today, the world's biggest funds and tech giants still quietly choose Singapore. It's a tiny island in Asia, yet manages over $4.7 trillion in assets. But the key question is, why do billionaires and VCs keep coming back here? I'm Sagar Kopchandani, founder of Greenwolf Global. We help founders and family offices structure and expand across 14 plus global jurisdictions. And here's the important part. If you're raising capital or planning global expansion, VCs almost always push for Singapore because Singapore has credibility. And in global investing, credibility is everything. In this video, I'll break down 4 things you really need to know about Singapore. Why global investors still prefer it over Dubai, how the tax and treaty framework actually work, the entity and the director rules most founders get wrong, and finally, the real numbers on taxes and the compliance. And if you stay till the end, I'll also share a simple decision playbook that founders can use to know when Singapore makes sense for them and when it doesn't. Singapore is home to 4,200 plus multinational headquarters Google, Meta, Dyson, Tencent, and many more. It's called the Switzerland of Asia, and not without a reason. Like Switzerland, it builds its brand on banking trust, political neutrality, and legal certainty. So let's start with 3 reasons why Singapore is investor favorite in Asia. Number one, tax treaty and credibility. Because Singapore has 80 plus tax treaties. That number may sound modest, but here's the twist. Its treaties with the US and Europe are stronger and more respected than most others worldwide. Example, Walmart, a US entity, acquired Flipkart, an Indian entity, for $16 billion and routed it through a Singapore holding company. Why? Treaty benefits and investor comfort here. Because Singapore has 17% corporate tax and 0% capital gain and dividend tax with very clear rules. That makes investors feel very comfortable here. Second comes banking and capital flow because over 200 global banks operate here. Talk about DBS, OCBC, UOB, Citi, HSBC, Goldman Sachs, and all within a few square kilometers. And here's the catch. Most founders underestimate this one. If you try wiring $50 million, banking credibility will matter more than a 0% headline tax. That's why banking is critical and Singapore has it. Third is investor psychology. Because funds love governance. Talk about Singapore boards, auditors, courts. Singapore has it all. This is really very important, and many LPs even refuse to back a startup unless it is actually set up in Singapore. That's how deep the trust runs here. Now let's get practical on how to set up an entity in Singapore. Singapore is one of the easiest places in the world to set up a company. The most standard structure used here is a private limited company, which ideally requires minimum one shareholder who can be a foreign shareholder too. And a minimum one resident director is required, and that's a mandatory thing to have. And that person could be a citizen, PR, or EP holder. And the paid up capital requirement is as low as one Singapore dollar. So it sounds simple, but here where most founders mess up. They sometimes use unsafe nominee director without having any safeguard. And that's one risk you have to be careful about while setting up in Singapore. Now let's talk about the numbers founders really care about. Taxes in Singapore. Starting with the corporate tax, it's 17% here, and with few exemptions, the effective tax rate here can drop to 8 to 12% for many. And the dividends and the capital gains, as told earlier, they have zero tax. Although there's some conditions you'll have to be mindful of in getting them. Third is GST. GST is 9% and exports are zero rated. That means there's no GST on exports. Although you will have to file some annual returns here. So annual return filing is mandatory. And if your turnover is more than 10 million Singapore dollars, audited accounts are also mandatory here. And the most important part about Singapore is you need to have a substance here. If you are availing treaty benefit, you need a local director, office, payroll, etc. So without having them, you can be denied treaty benefits here. Okay, another important part in Singapore is it follows a territorial tax system. That means income earned outside Singapore is generally not taxed here unless you bring it into Singapore. So if you're running a SaaS company that is serving US or EU or any other client, those profits are often outside Singapore's tax net. So that's a benefit you can avail as a founder. So How should founders decide in 2025 and beyond? Here's a simple playbook that you can follow to decide. So, if you're raising global capital, go for Singapore. And if lifestyle and 0% personal tax is a priority for you, go for UAE. And if dynastic wealth and trust is a priority for you, then you can go for Liechtenstein or Luxembourg. So that clarity is why Singapore remains the gold standard. I'm Sagar from Greenwolf Global, and this is just the first in my 14 country series. We are going deep into the world's most important hub with practical insight you can actually use. Next, I'll talk about UAE free zone versus mainland and why 0% tax can sometimes backfire. So hit subscribe because this series will change the way you think about global structuring.